Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Paulo Macro. Hi there. Welcome. Great to have you on.
Thanks, Maggie. It's great to be here.
So, before we dive into our conversation, just a little background. We are taping this on Monday, September 23rd. And if you are watching this on YouTube, you will notice that one of us is not on camera. Paulo Macro, as he's known on X and Substack, prefers to remain somewhat anonymous. And we are going to absolutely respect that. So what you are seeing now is something that many of you probably recognize, that his X profile pic, Cloud Bear. For those of you who avidly follow him and recognize it, uh, you already know and are familiar with his work. But for those of you who don't, Paulo has spent over 20 years on both the sell side and buy side at bulge bracket banks, brokerages, asset managers, and a variety of roles, and most recently focusing on Latin America. And I think you'd agree, Paulo, as you've said, you're best known for your view that developed markets are looking more and more like emerging markets due to the rise in public debt and structural inflation. Does that sum it up pretty well?
Yeah, yeah, you nailed it. I think that was a great chat, and thanks for having me on. No, I'm kidding.
I know it's always funny. So I say somewhat anonymous because we did have the pleasure of meeting in person at a collective dinner, which was so fun. And so I'm really excited to sort of get up to speed on everything you're thinking about the global economy. But let's just start with that profile pic, because I'm interested why you chose that. Do you consider yourself a perma bear?
Yeah, although I guess I was forged in the crucible of bear markets early on. I started my career pretty much right at the top when money looked the easiest, and going to Wall Street was a no brainer back in the 2000 kind of pre 9/11 period. And when your first few years are sort of that slow bleed of the tide going out, I think it kind of scars you forever. And there were a few good years there after, when housing went into the big bubble of the 2000s, but the GFC was such a huge ordeal for so many in the industry immediately after that, that to go through two pretty big ones within the span of a decade early on in your career, I like to think that I have that sort of deep bearish bias in me that I have to fight every day. And it's been a difficult fight for the last 15 years, admittedly, as U.S. equities have been the only game in town, and our exceptionalism seems to know no bounds. But I was fortunate also early on in my career to have exposure to commodities and related equities, and international equities. And my background, while being born and raised a New Yorker, I'm the son of Brazilians. So having kind of a foot in both the US and emerging markets in Brazil, on both the personal and language side, as well as the professional side, has, I think, given me a sort of broader skill set and experiences that today I think are adding a lot of value to my ability to sort of try to look around corners at least, and see where all of this is going, with what you mentioned at the top,
Mm.
the explosive fiscal situations in the West, particularly in the US, how developed markets are increasingly looking like emerging markets, how this will change the nature of recessions going forward. I like to say inflationary recessions create monetary illusions, and
Mm.
that these are experiences that are not familiar to Americans, but will increasingly become familiar, unfortunately, but are also part of a larger transition, that will see a lot of volatility, I think, and a lot of opportunities to make money in the years to come. But it's also an experience that Brazilians and Turks and South Africans and emerging market populations know quite well. And life does go on. But I like to think that the moment has sort of arrived for people with different backgrounds to be successful in a market topology that's changing quite dramatically from the kind of classic buy and hold of America.
Yeah, that is there. That's so interesting, and there's so much to unpack there. I just want to pick up, and I love that you said that it's a sort of bias that I fight every day, because there is a really interesting psychology of folks who have been forged through those two really painful experiences, and I would say maybe even some that are older that experienced a sort of sideways dead market through part of the 70s and 80s for equities, which again is very unusual. So maybe a different, less crisis and more just sort of a different environment. Do you think that it sounds like you've considered the idea that that might be a handicap as much as it is a superpower? Like, it sounds like you've thought about whether that is just post-traumatic or whether it's actually a skill set. Talk to me a little bit about that, because it sounds like you've been swapping stories with people on that.
Sure. Yeah, the bias certainly cost money and sanity in the recovery from the great financial crisis. There were many like me who, even saw the crisis coming and managed to make some money out of it or preserve capital through it, but then missed the turn and mentally began to fight what was happening and learned, in some cases too late, that a narrative had gone in the new direction, that
Mm,
the Federal Reserve was going to step on the market for years and ensure that asset prices were going to continue to inflate. And in that classic saying of, I guess, the market can remain irrational longer than you can remain solvent, there's also that whole, trends can always go much, much further than you ever dream of. And when they end, they can end more suddenly than you could ever prepare for. And that sort of long, inexorable trend of the 2010s and the US recovery story, and the general sort of concentration of capital in the US as
mm,
not only the spot for primary recovery out of the financial crisis, ironically, of course, because we were sort of ground zero from the housing market perspective in taking the world into a synchronized deep slowdown and recession in the first place. But that it never occurred to me that capital would concentrate here to such a degree that, that the foreign central banks, that were once considered, the sort of bellwethers of responsibility and monetary um, responsibility, I should say, like the Swiss National Bank, would own mega cap equities like Tesla and Microsoft. If you had said that to anybody in 2005, they would have thought you were crazy. And then 10 years later, there we were. So these sorts of trends can always run much farther than you ever imagine. And if you're looking for the penny to drop at every turn, you end up sort of missing the obvious of what's happening right in front of you, which is your sitting can do a lot of the work. And there was a learning experience for me and many others who had that sort of bearish bias, to let go a little bit and, take the data at face value, take the narrative at face value, and try to agree with the market wherever possible and let the market do the work for you a little bit more.
mm,
I'd like to think that I'm a contrarian, but only insofar as I see a very diluted narrative that's starting to fail.
mm,
Um, One of my sort of trading and speculative heroes would be Bruce Kovner, and he used to say a lot in his early career, and this was mentioned in more than one book, that he looks for a consensus that the market is no longer confirming. So if everybody believes that, the markets look great and everybody's fully allocated, and, we're starting to make lower highs and lower lows, clearly the market, that's a very obvious one. The market's not confirming that consensus view. And likewise, a market that's no longer making new lows, but where everybody's bearish, something else is happening. And he used to say, I like to know that a lot of people are going to be wrong. And
mm,
it's their move away from one narrative to another that drives a trend or a reversal and an extension into a new direction. And the other thing, when I look at a chart, for instance, that's trending very nicely, that to me, I just view that as the spread of an idea. And at first you sort of get the incipient kind of reactions to the idea, you get the fighting of the idea, the resistance, that proverbial wall of worry, and eventually you get total agreement in the idea. And the way asset prices behave on the screen, even as simplistic as it sounds, tells you a lot about who believes in this idea and how
mm,
strongly, and
mm,
how kind of bought in people are. So there was a painful adjustment period in sort of letting go of past biases, and I know I still have them, and I still try to fight my inherent biases that go back a long way to my formative days, as I mentioned. But
mm.
But yeah, hopefully that kind of answered your question.
Yeah,
I
no,
try to
it
be
does.
agnostic.
I think this is so interesting because you're really articulating something that's a little bit elusive sometimes, which is why there's so much disagreement. You know, if you look across X, and I know you participate in a lot of debate there, uh, it just seems like people are living in different worlds sometimes. And some of it has to do with time horizon, but I think some of it has to also do with people who have the experience, have been through things and see things coming and are talking about them, and other people who may be coming from a different point of view, maybe have a different time horizon. But it's really fascinating to hear you talk about that because I think it puts a little bit of color beneath what are some disagreements. Let me ask you really quickly too. I'm talking about the debate on Twitter. We talked about Cloud Bear and explaining why that is your symbol that you go by. Why stay anonymous, by the way?
A couple of reasons. The primary one really is that I was actually I found that my following on Twitter seemed to most enjoy the longer form threads rather than the occasional kind of two liner. And the move to Substack was driven in part by a desire to go back to writing more long form, which was something that I did for many years when I worked for banks.
Mm.
Extended sales comments and such, and kind of general market commentary and bigger ideas. It's hard to distill these things down to little bite-sized,
Of course it is. Yeah.
Twitter threads. But it occurred to me in moving across that the anonymity had actually served me quite well, both in terms of minimizing the brain damage that might come from occasionally some of the darker side of
Mhm.
what gets thrown around on the internet, but really more because my fear was that for better or for worse, um, my experience might, you know, seem great to many and seem kind of juvenile to others, or depending on what seat they're in. But it felt like none of that really mattered to what I was trying to write, and that the last thing I would want is to drop my anonymity or pseudonymity and have that affect my writing in any way.
Yeah, that makes a lot of sense. You're putting the focus not on the trappings of whatever your career may have held, but on the idea. You let the idea sit out there on its own without.
Exactly.
Yeah.
Exactly. And I know that may sound like a cop out, but I breathe a lot easier and I write a
Yeah.
lot easier. There's no real labor to when I sit down to write something and feel inspired to write, because I think the people who follow me generally understand that I'm I'm not looking to sell a resume,
Yeah.
or a past. I'm just thinking about the markets and trying to solve the puzzle that cannot be solved.
Yeah. No, I think it also allows people to come at the work based on the virtue of the idea itself and not
Yeah.
assume, like put assumptions behind that. We all do that, right? But put assumptions behind where you're coming from, then you're paying a little less attention to the idea. So I totally understand that. Um, so okay, so let's dive in a little bit here. I'm so interested in this sort of broader structural issue, and it's so important right now given what the Fed did. But I did want to start on oil because, as I mentioned, we're taping this on the 23rd, and we are really starting to see a drumbeat of geopolitical tensions heating up in the Middle East. It's been a little bit sidelined for investors because of the big move from the Fed and the surprise around that, but clearly we're in very fraught times. Are you surprised to see the action in the oil market that appears to be pretty subdued given some of the serious developments we're seeing in the Middle East? How are you thinking about the oil market here?
To that point specifically on geopolitical risk, I guess you could say I'm surprised but not surprised in the sense that geopolitical risk since the invasion of Ukraine 2 years ago has been consistently faded.
Mhm.
And there's a bit of reflexivity that's occurred in the market since then, where every time we started to see hints of a tightening in financial markets around oil, specifically in futures and options and listed derivative products, there was something that came along in the physical market that stepped on it. And the examples I can give you are first the obvious SPR release during the summer and fall of 2022 by the Biden administration, although there were SPR releases elsewhere. The big one was here. Then there was the enactment of sanctions on Russian exports by Europe at the end of that year, In November, December, you'll see another big kind of washout in oil and in positioning. That was Russia releasing something like 40 million barrels of crude plus another 40 million equivalent of diesel, just to make sales ahead of the curtain coming down. And then the oil market took a few months to find its footing, but we had that run in the summer of 23 that culminated in just ahead of the Hamas attacks in early October of last year. And immediately the oil market collapsed, which I think threw a lot of people for a loop because, here we are, seeing a real conflagration developing in the Middle East with multiple actors involved. And why would oil be selling off? Going back to the Bruce Kovner example of looking for a consensus that the market's no longer confirming, this what was really happening was that you had Iran making aggressive sales while the Biden administration looked the other way. And I don't mean to sound political saying that. It's just the honest truth. Iran's exports have skyrocketed over the last year, in that we've seen them discharge anything that basically wasn't anchored down, mostly to Asia, in an attempt to get revenue in the door, because that's the natural reaction of a state actor that's potentially going into a fight. And we saw something around, I think, I can't remember the exact number, 50 to 80 million barrels of crude and naphtha sold to Asia in that time. It basically, Iran dumped all of their floating storage that they had been sitting on for several years. And the market collapsed into December of last year. And these things take time to heal. But my point in mentioning these is that every time it felt like the financial market was starting to really go on a run on the upside, a physical seller came along and hit the market aggressively. Famous last words to say it's different this time. But in a very unusual fashion in the last few months, we have seen a profound weakness and give back in the financial markets around oil. And I have yet to identify a significant discharge or seller in the physical market that has come along and stepped on it. And we're seeing a great deal of divergence in the oil market between how futures and the quote unquote paper market trades versus the physical market in simple things like the premium for dated Brent, which is immediate delivery versus the front and second month of the Brent futures curve, or the fact that time spreads continue to remain backwardated. This is basically a way to punish storage and call crude into the market where your near dated prices are higher than the farther dated prices. In prior sell-offs, we've seen these premia collapse into discounts on the physical side because people didn't need the oil right then because we were drowning in it from a sale somewhere. That hasn't happened this time around. And absent a patch of weakness this summer in sort of the June, July timeframe in Asia, the boats have started to move again pretty aggressively, and we never really tipped into contango or into discount on the physical side. And so we have a weird setup here. And in this context also, the price for Brent and WTI, the flat price that you see on the screen, collapsed to a level where we have seen across the complex, when you consider diesel, gas oil, RBOB, gasoline, as well as WTI and Brent, a net short position for the first time in the history of the commitment of traders since the ICE started to trade the Brent contract. Now, there was a net short position in WTI following Lehman, but if you recall, not only at the margin did the demand for barrels collapse in the worst recession since the Great Depression, but we also had a situation where financing was simply unavailable. So if an oil trader wanted to buy and take delivery of crude, store it, sell it forward, and collect that contango on the curve, the price of financing that position got so extreme because of the Lehman failure and that banks were simply not lending money for any reason, that you had Exxon and other majors internally funding from their own balance sheets immediate delivery for crude oil at $20, $25, forward selling 2 months later for 30 or $35, and parking over a dozen VLCC 2 million barrel type tankers off the coast of Houston in an enormous carry trade that was profitable to the tune of 10, 15, 20% a month during that window. So the speculative community was so net short that was the profitability required for the commercial entity in the market to store and forward sell and hold on to crude. Today, we're in this kind of weird upside down where the speculator is short, but and I'm using that as a broader asset class,
Mhm.
excuse me, investor class. But so the commercial is not long against that, and normally that commercial uses these products to hedge physical trades. So it's a very rare thing for the entire complex, as it stands, to be net short. It'll happen in a specific product, diesel or gasoline, at areas of points on the curve, or times of year when refineries are in turnaround. But it's so unusual for the entire complex as a whole to be net short against the commercial community that requires a net long by speculators to
Mm.
hedge risk.
Mm.
And at the same time, the physical market is tight. We continue to draw globally on inventories. Time spreads continue to tell us that they will punish stores. Um, and physical premium remain, excuse me, the physical versus fronts remain in a premium, as opposed to a discount. So somebody somewhere is buying crude, and using it, and yet the speculative market has kind of set itself up for whiplash here, in my opinion, with this recent sell-off in the last several weeks. Because I even joked to some of my readers this weekend, I feel like the entities that trade crude oil now are so computerized and CTA focused and
Yeah.
mechanical that there's no kind of stepping back from the screen and asking yourself, like, what is really going on here? How do we square this setup with what we're seeing in the data? Maybe I find out in a month or two that the physical market does collapse and there was a huge seller waiting in the wings. But for now, this one feels very different, and it's a unique setup, I think, for people to take a constructive view on the complex and pick their spots. Because if you don't buy when everybody's bearish, when do you? Sorry, that
So
was a very long answer, but
no,
it's
but fascinating from a perspective that many of us don't get to see. And by the way, I just want to interject that this is exactly why the great financial was so traumatizing, because when the markets stop working, when the financing of the global economy just grinds to a halt and the wheels almost come off, there are all these knock-on effects that you can't even imagine. Like, no
that's right.
one can get money for anything. That's why it was such a big deal for those of you if you did not experience it. I saw so many really, really veteran policymakers and you know executives and traders just so fearful at that time because they understood the repercussions that we couldn't even say. Um,
That's
so
right.
it's just
And
a great little sort of, I think, tidbit about what you referenced before.
yeah, and that's what's so wild about this setup is that, like, I look out the window and I'm like, well, the test is always, is the world ending? And I look out the window and everything seems fine. I just got back from Brazil, everything's humming there too. The oil market is trading like we're in a crisis, and I can't explain. I haven't been able to get to the bottom of why this has happened, but I just know that the setup, we haven't seen anything like this outside of Lehman. And so
It sounds like it's making you nervous.
either there's something terrible right around the corner, which is not my base case, or this is one hell of an opportunity to reload on energy, especially considering that, going back to your initial question with the geopolitical angle, it is precisely the conditioning of investors to sell geopolitical risk premium over the last 2 years that has rewarded them and lulled them into thinking, Iran will send 300 drones and oil is flat on Monday.
Mhm.
I joke with friends now on Sundays, like, boy, escalation with Hezbollah, get ready to sell oil, first thing Monday, because it's become almost Pavlovian conditioning for investors to harvest geopolitical premium, to the point where, we could be on the precipice of a real rupture in the region, and there is absolutely no premium
Fear.
for war or geopolitical risk in the barrel right now. That's incredible to me.
Or anywhere, right?
Yeah,
In markets. Like and I understand the complication of trying to make a direct connection, but it's pretty extraordinary that you're not seeing it play out anywhere. There
that's right.
seems to be a complacency that is, but as you say, it's been reinforced. So, people who say, well, I got to listen to what the market's telling me, which many traders, as you know, will say that. Well, they're listening to what the market's telling them. When
Yeah.
you mentioned a big player in the market. When you're talking about that, are you talking about funds? Are you talking about a country like China? Because people have been trying to figure out what China's approach is. They were They've been buying and storing when they think they need to, but there are a lot of concerns about what's going on with that economy. Do you think that they're involved at all, or is this more in the financial end, or another entity if that would be large playing in the market and be able to move it in a certain way?
Sure. Um, China's the bear case around China slowing growth, the Chinese kind of Japanification and the real estate implosion sort of parallels to early 90s, mid 90s Japan, is certainly a huge part of this story for the bear case. The two things that bears will, and being trying to remain agnostic and fight a perma style, I try to put myself in the skin of the guy who's on the other side of my, or girl who's on the other side of my trade. And in this case, the bear case seems to come down to Chinese weakness and weak demand for products in the West, and the U.S. risk of recession as reflected in crack spreads, basically refinery margins. And to the China point that you mentioned, there was a weak patch where they seemed to step away from the market and were importing less and also running refineries less at lower rates earlier this year. The market has acted very weird, though. We drew counter seasonally in the first quarter when normally we build stocks globally, and that seemed to be China. Then we built briefly in April, May, and China slowed down in June and July in terms of their crude imports. So there are things that have been happening in the crude market month to month that are a little too short term for me to really do anything with. But in speaking with traders who are closer to this market, especially on the physical side, it's been an unusual year from Jan 1. But what's really interesting more recently is China has suddenly picked up. And in classic Chinese fashion, they love themselves a sale. So if you show them Brent at 70, they're in there buying. And normally I would say, okay, so the boats are moving. We see that the import numbers are going up. The arrivals are going up. September is actually shaping. I know it's only the 23rd, but at the current the run rate of what's arriving in China, September would be actually an all-time high for the month of September in terms of Chinese imports of crude oil. So the notion that China is collapsing in terms of crude demand is simply false when you look at the recovery since July.
Does
But
that speak to their economy, or are they just cleverly building their own strategic
yeah,
reserve because they know we're moving into a multipolar world and there's an election and no one likes, neither side. It's the one thing everyone agrees on is seemingly getting more aggressive on China.
sure.
Is that just preparation? Does it really speak to their economy?
It's actually both.
Mm,
In the past kind of 18 months, wherever we've seen China sort of wave in at lower prices, we've seen their sort of percent fill rates go up, in that their refineries aren't necessarily running harder. They're just filling their tanks up. And China has built an awful lot of storage capacity over the last 3 or 4 years that they want to fill, but that they want to fill at lower prices. And this will be sequestered. They may trade it out at the margins, but once it goes in, most of it's never coming back out. They want that buffer. They're not going to sell a couple of 100 million barrels for political expediency to
well, they
win
don't
an
have to,
election. They don't have
right?
to.
They don't
That's
live.
not
They
what they
don't
do.
live in that kind of pork barrel necessarily. At least right now,
Right.
that's a whole other conversation.
It
As
may change, but
yeah,
for
as
them, it
they're
truly is
yeah.
strategic. Yeah.
So when you
But
when
more
you
recently, what's interesting about this bounce is we haven't even seen the stimulus that a lot of people are now starting
yeah,
to talk about, especially today, after their rate cut overnight and the talk of a special meeting tomorrow. But their percent fill rates are not going up, so it seems like they're actually consuming the oil that they're waving in over the last sort of 6 to 8 weeks.
mm,
Whether this is just another temporary kind of timing hiccup where they're moving product, distillates abroad for export to collect more money and just kind of taking the market as cheap, remains to be seen. But it's interesting that I would have just expected to see them filling the tanks, and
mhm.
they actually seem to be using it, and that the percent fill rates are remaining stable despite higher imports. So maybe there's something there. We'll see if the kind of stimulus gives it if they do announce something, it kind of gives everybody the confirmation that they're looking for, that maybe China, at least in the interim, has found a bottom. Um,
which would be
I
good for the global economy. Although many
yeah,
people have been disappointed about that before. There seems to be perennial disappointment about what that stimulus looks like, or maybe the Chinese have a different idea of what they're stimulating as opposed to what everybody else wants to see.
I think that's a great point, and dovetails very nicely as well with the fading geopolitical risk over and over it. You know, the investor base. I was actually snookered into this as well, thinking coming out of 2022, I think it was 2 years ago, when they finished their last lockdown, that they were going to embark on a real reopening, and I unfortunately sort of underestimated the damage to the Chinese kind of especially consumer psyche
Mhm.
in the rolling lockdowns and what they had gone through. That their sort of reopening trade simply did not materialize. This was actually perfectly coincidental with late 22 and early 23, where a lot of people were looking for commodities to move off the mat, and it just didn't happen. So there has been perennial disappointment there as well. We'll see what happens. I tend to think that the longer people sort of believe that something will never happen, the gradually the risk goes up that it eventually will, because you really need people to simply never believe in it again for it to actually start to work again, looking for narratives or consensus that the market's not confirming.
Yeah, and
But we'll
you
see.
do seem to get to that point because it's very hard to find a I don't even wanna say a China bull. It's, like, kinda hard to find somebody who's not a China bear, and they've gotta stimulate without reinflating, right? They're still very
Yeah.
hard to do when you're coming out of a bursting real estate or managing a speculative bubble to sort of be able to they're trying it sounds like they're trying to be a little bit more surgical about how they're doing it, which doesn't seem like a big wall of money, a bazooka of money coming if you're sitting on the outside.
Yeah,
Are you
it certainly won't look like what we've seen in the past. My impression, and I've tried to surround myself with people more recently over the last year who know China far better than I do. And as someone who came up sort of trading commodities and related equities in the 2000s, I picked up a lot of China through osmosis. But I don't presume to be an expert on China. It's simply become too much of a black box. But I do have my own inherent biases to fight there as well, and people I speak with who are closer to the situation remind me that the China, even pre-COVID from 5 years ago versus today, is vastly different and more
Yeah.
developed. People simply just don't travel there anymore. I have to be reminded as well, more recently, someone reminded me that China consumes 4 barrels per capita per year. The US and other developed markets, like South Korea, sit at 20.
Wow.
The lucky billion, the Australia type developed markets consume around 13. So in that context, China at 4. We have to see if China grows old before it grows rich, which is kind of a big demographic question for them. But Thailand over the last 20 years moved up from 3 to 7. If China was just to move to Thailand, forget moving to the 13 barrels a year per capita of the developed West, that move from 4 to 7 for China would take crude imports from approximately 12, 13 million barrels a day today to 23.
That's the
I'm,
thing, you just need
it's
some
not much.
movement on that
Yeah.
on that's a gr I love the barrel per capita, that's a fantastic way to think about that because we tend to make assumptions based on size or the middle class. You sound like you definitely are trying to look for what could be a huge opportunity in oil. Are you thinking about commodities as a basket? Do you feel the same way about other commodities? Are you in that kind of hard asset group, or is oil a separate narrative because of some of the unusual action there right now for you?
Um, no, I'd go with your first categorization. I'm generally biased bullish to commodities because of the varying degrees of underinvestment. I tend to focus more on supply side than trying to guess at future demand. I like to think that there's runway to demand, like the barrel per capita example I just gave. But really, the driver for higher prices will tend to be um, easier sort of for me to get comfortable around based on supply constraints and underinvestment over time, than anything like guessing at how big China's stimulus will be next quarter, or how weak the U.S. economic outlook would be next year.
Mm.
And to that end, there are certain commodities that have been woefully underinvested in. Oil is not alone in my portfolio as as sort of a generally bullish participant across the complex, but it will vary. One of the Sorry if this goes off on a little bit of a tangent, but one of the realizations I had actually came from a friend of mine who talked in the post-COVID kind of euphoria of 20 and 21 of this era of rolling bubbles, and
Mm.
how even within the crypto ecosystem you were seeing different sort of rolling crack ups across the complex, where Bitcoin goes first and then Ethereum doubled, even though Bitcoin had already made its high. And then you had some of the Dogecoin stuff when Elon Musk went on Saturday Night Live, and that it went to 90 billion. And it occurred to me that these things were happening at different times, and I started to note this sort of behavior in commodities as well.
Mm.
And this is a different sort of experience than just being long commodities all the time, like in the 2000s when the Chinese demand statement and the emergence of China post the WTO admission sort of lifted all boats. This time around, because these commodities have been supply constrained for and underinvested in for so long, over 10 years, we're seeing the sort of acuteness of underinvestment show up in commodities at different points in time. So again, unlike just throw money at commodities because they're all going to work, sell dollars and long commodities against it. I tend to think that a more active approach to understanding individual commodities, their substitution effects, the way money will roll from one space to the next, has interested me in the last few years and served me pretty well, because I come with a background in this and something of a bias for the space in general.
Mm.
But look no further than what's happened with a variety of energy commodities since, call it 2021. You had TTF, natural gas, in Europe explode in the fall of 21 and then really go into overdrive following the invasion of Ukraine. You had thermal coal go with it, and then eventually kind of sag back, the two being interchangeable. Henry Hub didn't work until suddenly in April, May, June of 22, months after the invasion. Balances tipped one way, and the commodity ripped from 3 to 9 in the span of a couple of months. Then suddenly in 2023, uranium started to work and doubled. So you have, and all of this while oil exploded right into the kind of low 100s on the invasion, has been sort of sagging back and chopping a range after the initial pop. So there's we live in a different world from the commodity bull market of the 2000s, in the sense that it feels a little bit more actually like the 60s and 70s, at least in terms of what I've read,
Mm.
where a more active approach to identifying when the pinch points of certain commodities might occur creates these sort of rolling crack ups at different points in time that allow for compounding of real returns that move the needle, especially since commodities as an asset class tend to live in the tails anyway.
Yeah.
These tails can occasionally become pretty mispriced.
It's so interesting that you say that, and it's a fantastic observation. What worries me is that a lot of times as this gets, let's just say, circulated more widely in a broader manner to investors, it sort of dilutes into bullish commodities. And then the sort of ordinary investor, retail investor, individual investor, whatever you want to call it, longer term investor, maybe there's a risk they get sucked in at the top, right?
Yeah.
And then you see that what you're talking about is a big move, but we know commodities can be very painful on the downside too if it collapses or sort of moves back to equilibrium. It sounds like it's a more dangerous place for an individual investor. Even if you buy some of the structural arguments behind it, it sounds like you have to be very nimble, and it's much more complicated. Is that
Yes.
fair?
Yes, I would say so. It's any kind of complex that tends to live in the tails and rips and collapses is very difficult for the typical investor, never mind individual or retail investor, to stomach. Sizing appropriately is key to everything.
Mm.
It is very difficult to diversify within the market that is volatile like that. Um, And so, yeah, caution is certainly warranted. Expertise is warranted. There are some managers out there who have kind of gotten this joke and have the. I wouldn't necessarily count myself as one of them because I try to learn something new every day, and the market certainly likes to seemingly teach me a lesson every day, and then just send me the bill. But it's certainly a very volatile space, but volatility can be your friend or your enemy, and if you play small or are have a reasonable level of knowledge and expertise, and there are returns to be had there that certainly for many years in the commodity space just were not there because the volatility of the space um, was very low, and we were just in a long drawn out structural bear market that was driven by oversupply from the last cycle in the 2000s, right? So
Yeah.
where these cycles can be very extended, but this one feels to me like it will manifest and kind of reflect in commodities in different ways. Not everything has to be a moonshot, but for now, going back to your original question at the top, if this is just oil centric, I don't mean to seem like I'm obsessing about oil lately, and I certainly have been to my very patient subscribers and fans and friends on Twitter. But it's only because the situation just seems so obviously acute at the
Mm.
moment for this particular commodity. Um, I I also liked something you said earlier, where I don't know if you use this word, but I tend to avoid contentious trades.
Mm.
So I lost a little money on Tesla back in the day as a kind of a bear and a skeptic. I largely stay out of a name like that now. Every once in a while, I'll punt something small in it, but there are just certain complexes or areas in the market that are very contentious where nobody really seems to win. Oil kind of got like that a little bit over the last year, which made me nervous to even really start to become vocal about this
Mm.
over the last 2 months. But only in the sense that more recently, it seems so obvious that China has problems. It seems so obvious that the U.S. is going into recession, and yet the physical market continues to tighten. So it's kind of like, all right, you either really need Lehman to happen now, right? And we're really going to go for it, but if you're wrong, and we even just kind of get a muddle through here, or an inflationary recession where nominal growth continues to cycle 3 or 4% positive as opposed to negative, but inflation ticks back up to 4 or 5. I don't mean to go on too much of a tangent, but I try to think like, what would the world look like in a year or 6 months if I'm right and oil rips, right?
Mm-hmm.
And I tend to think it's a world where the American consumer who has been rotting from the bottom up, the Dollar General,
Mm.
the poor cohorts are feeling the pinch of inflation, but the more wealthy cohorts and higher income cohorts have the tailwind until recently of having termed out their mortgages and other debts. Rather than vehicle and credit card loans, which tend to be marketed towards the lower income cohorts, and those hang on a short dated money rate. Um, but they are in the process, going back to the wealthier cohorts and higher income, they're collecting much more interest on their money. So the Federal Reserve has really helped them out while punishing the lower incomes. And it's the lower incomes who consume, or whose delta in terms of sensitivity economically consumes more volume rather than parks and stocks with spare income. So
Mm.
there is kind of a window here where if gasoline and oil following the election were really to start to move higher, where you get kind of a double whammy on the bottom, that the Fed, in trying to cut, 50 bips is really nothing for an auto loan or a credit card bill. And they may cut another 50 or however much they want to loosen financial conditions at the front. But the oil tax on the consumer in America will kind of go straight to their heart with a 1 month lag at the pump.
Mm-hmm.
And in this kind of setup, you also are talking about potentially a rollover in the dollar, because you're taking a lot of the air out of the U.S. exceptionalism and carry trade, and a lot of foreign money that was already parked here may decide that growth prospects look better at home, and just that rotation alone will kind of touch off this long-awaited developed to EM or rest of world growth to value, tech and defensives, especially. People have really crowded into utilities, consumer staples until very recently. Those sectors have, with exception of utilities in the last 2 days, on account of the Microsoft 3 Mile Island announcement on Friday, has actually been hurt pretty hard. People are taking money off the table in defensives. What if cyclicals start to work and energy drives that? But at the same time, that is a tax on the US consumer wallet. And we could end up in a place where by middle of next year, we're cycling, 4% nominal, but 5% inflation. And it feels, it looks like -1% real, which I guess technically gets people to thinking recession, but it feels different because everybody has a job still. And there's like a stasis in the job market that the Fed will take a victory lap over and say, hey, we actually fought this pretty well. And our dual mandate is price stability and full employment. It's not growth necessarily, it's employment. And
Yeah.
so we could
So
live in a
it's like a soft landing that feels horrible to everyone.
yeah, exactly.
You
And
know,
this
it's like,
that's
great, we got a soft
exactly it.
landing, but we're poor because we
That's
can't do
exactly
the
it.
things. Yeah.
And this is something that Brazilians know so well. So when people ask me, like, what do you mean by inflationary recessions create monetary illusions? I mean exactly that.
Yeah.
That's kind of the bottom line. But it takes higher oil and higher energy prices that feed directly through to the cost of living for everybody to feel more miserable and for the misery index to go up, but everybody to still be working. They just hate life.
Right.
And
And they don't feel like their wages cover their, their everyday,
that's right.
especially because, by the way, the Fed cut rates, but it didn't reflect at all in mortgage rates or car. The bond market doesn't have to follow the Fed. They don't appear to be doing. I wonder what your sense is about the reaction in treasuries. Granted, it was 50
Yeah.
basis points, which, as you say, at the margin, maybe it's a pivot. It doesn't. It's not. Not that much in terms of, but there's no guarantee the bond market follows the Fed, and it didn't appear really to have a very big move. What
No,
you thought about
the
rates there?
Yeah, no, I'm glad you brought that up because I was very vocal with friends and subscribers that the Fed eventually cutting, and especially if they were to cut 50, would actually touch off a sell-off in the long end that could potentially reverse this bull run that we've had in longer dated bonds. If for no other reason than a more active and aggressive Fed in cutting the fronts. And when people say bonds, sure, near dated money will follow the Fed. So the 2 year may be over its skis by a bit, or under anticipating what the Fed will do on any given day. But the longer dated money is the reaction function to the long bond is different. If they see a Fed that is cutting aggressively, and therefore it looks like they may have more success at reflating growth, but we're already at kind of potential. This is very Brazilian, by the way, because Brazil doesn't invest. So if Brazil starts to grow even 4%, inflation explodes. We're kind of setting up in this country, given the lack of underinvestment and the focus on financial engineering, hyper financialization, buybacks, et cetera. Our talents don't lie in making things for some time here. The reality is any sort of move off the mat again in growth could touch off inflation, and the long end in seeing a Fed being aggressive on cuts, thereby increasing the probability that we avoid a recession, means that a reflationary growth bounce trade that the Fed is cutting into the teeth of, that's the worst of all worlds for the long end of the bond market. It's just simply a view that the probabilities of a hard landing or some kind of recession are being reduced by the fact that the Fed wants to be aggressive. Where it gets really screwy, Maggie, and going back to what the world looks like mid next year, is that with all of that happening, you have an encouragement that people will increasingly send their money abroad,
Mm.
for no other reason than, okay, the Fed's cutting, so they're taking the wind out of some carry. To your point, the Fed's hikes didn't really do much to slow things here, although they like to take credit for them slowing inflation. A lot of the inflation that's slowing was kind of baked into the cake 2 years ago. But they were not responsible for cooling housing or corporate activity because consumers got the memo during COVID and termed out, corporates as well. So if the Fed's hikes didn't kind of drive a stake through the US, where was it most felt? It was felt in the rest of the world. through that kind of persistent bid in the dollar over the last few years until more recently. And so my logic is, if the Fed now starts an aggressive cutting cycle, doesn't it stand to reason that we may not actually get the shot in the arm domestically that people think, but that the rest of the world will feel like the boot just came off of their neck because they were the ones who felt it most acutely over the last few years. And we didn't, because everything felt sticky here because debts were largely termed out here. So to your
Mm-hmm.
point, people will talk about long and variable lags, but I just tend to think that the Fed's actions are having far more of an impact abroad, and this will become clearer as we kind of move through the next few quarters. It takes a reflection in a weaker dollar to kind of confirm that, and I think we're starting to see that here. I certainly, if you see the Dixie, break 100, I think that will get people to sit up and start to ask these questions.
So in that environment, you not only have repatriation of international investors who are seeing better opportunity back home, but you also could have US money seeing better opportunity internationally. Is that
Certainly,
the setup you see?
certainly, I think there would be again, thinking of a chart as an idea catching fire, I think that you would start to hear consultants talk more about the importance of diversification with, an equity portfolio to include international and EM. EM versus DM in terms of, asset flow has been down and to the right since 2011. I mean, EM has just been demolished in terms of its investability as an asset class.
Yeah.
Basically, who wants to diversify into an asset class that only goes down for over a decade? Nobody wants that kind of diversification. They want the kind that goes up. And who knows if this is finally the turn, because, I'm as guilty of this as the next sort of bull on the complex in thinking over the last couple of years that we had hit that sort of inflection in 2020 and 21, and still waiting for like the real move. But I tend to think that the dollar will show us the way in the next few months. And then kind of zooming out more broadly, the rest of the world is a much more oil intensive and commodity intensive consumer, just like the poorer cohort within America is a more intensive consumer of volume rather than value. And there are a lot of them. And if we get that kind of barrel per capita moving even just a little bit in EM, regardless if it's in China or India or Southeast Asia, and the 1.5 billion people in that line from, Istanbul to Jakarta, the move in commodities that we could see here in the next kind of 9 months, it'll have a weird boomerang effect back on the US, because you'll see the Fed seeing growth slow because the consumer tax is hurting us incrementally as oil rallies.
But it's out of their purview
And it's out of
because
their
it's not
purview,
labor.
and they'll see growth slowing and unemployment potentially ticking up a little bit, and they'll want to cut, which only touches off more of this. So
So this is the inflationary spiral, right?
this
And the consumers
exactly.
will want wage inflation, but they will, if the wages start to come through. That's, we know that the Fed watches that. That used to be the most important gauge of inflation for them, right? Wage
Right.
inflation. But will in a world now, will corporates give them that wage inflation? I mean, this is where I know I know demographics. Let me just, which I want to touch on in a second, because then you
Sure.
throw that in this mix, and you really have a cauldron when you're talking about wages. But just to circle back for devil's advocate, when I'm listening to you talk about this world, if commodities are high, oil's high, emerging markets, if you are a producer like Brazil or Mexico, might be great. But if you are an importer, that's not great. Think India, parts of Asia. So that's not great for your consumers. And when you're talking about the global economy, we're talking regionally, but some of these mega cap, whether they're oil producers or tech companies, I mean, they may be domiciled in the US, but are they really US companies? Some people would argue with the innovation, they're best in class anyway. So you're going to see money go into them no matter what. Those
Hmm.
are the arguments you hear. And let's throw productivity onto that too, right? The sort of innovation that's going to come from productivity, AI in a developed country like the US. So you're an energy independent. I don't know if you agree with that. You've got the most innovative companies. AI is going to start to spread, robotics. You'll get a boost from that that'll help push back against some of these structural things. And
Hmm.
so this idea that we're turning into an EM country and that the rest of the world is going to be able to really outperform broadly is not going to happen. What do you think about some of those arguments?
Sure. Um, I'd love to spend a minute or two on demographics,
Sure.
because I think that's actually very. This will become something that people talk a lot about in the next sort of 2 to 3 years, particularly as it relates to the Fed and their view of employment or unemployment. Um, I'll come back to that in a moment, but to your question about it certainly stands to reason that rising oil and energy prices are a tax on oil importers and their consumers. Totally fair. In the context of a weaker dollar, if there is a domestic growth story where money is flowing back into these economies and investing locally, you can make the case that with fits and starts, real wages in these places should rise. And um, I think we underestimate to some extent the amount of investment that has occurred in human capital, particularly in China, and the waiting for Godot of the Chinese consumer to fill the vacuum of manufacture for export and real estate speculation and investment will eventually come. India is an interesting question. It could still take a few years, but they're coming from such a low level, and there has been significant investment there as well already. Certainly, they're the only large liquid market for foreign money that's allocating to emerging markets because of the sort of challenges of a U.S. investor investing in China and the sort of geopolitical risk that's being underwritten there to do so. Stands to reason that's reflected in the multiples that are available in that market today. But I see room for real wages to sort of keep up, and certainly considering that these commodities are priced in dollars. I'm not arguing for a collapse in the dollar or anything catastrophic, but certainly just a you know a reasonable decline in the dollar will go a long way towards fanning real wage growth, real income growth in the emerging world. And it's not obvious to me that it's an immediate tax on the EM consumer
Mm.
in that context. Again, there are certainly relative beneficiaries, and I would suggest that Latin America, for all its scleroticism, is certainly an area of interest for me. Again, in that context, as a sort of general net exporter of commodities and trade balances that work in a rising commodity environment for them. But they're not perfect down there either. But certainly there's room for these markets to move, and they've become so small in relation to the U.S. equity market and global markets generally that it doesn't take. I call it elephants through a keyhole. It doesn't take a lot of capital flow to really move some of these smaller markets down there. Um,
Yeah, I think that's the interesting point, right? Because we worry about valuation. So some of the other arguments I think I think generally go in the basket of U.S. Exceptionalism, right? The
yeah,
idea that there's the most innovative companies, the productivity. The issue is we have all these valuations. We have money that has been sitting here this long. So when you're talking about, you're trying to find, or you're looking at where the sort of narrative that's been ignored, right, or that's been underappreciated.
yeah. I try to stay away from contention, with the exception of oil recently. I like looking for things that have gone to sleep or that are sort
Yeah.
of invisible. And ironically, Brazil was quite visible a year ago, even on Twitter. Financial commentary. It felt like more recently, in the last 3 to 6 months, that both locals and foreigners really threw in the towel. And I wrote a piece about a month ago to that effect, where I was in Brazil in August, and in speaking kind of on an ongoing basis with local investors, it struck me how defensively positioned and sort of near suicidal the locals have been. They've been in contraction in the local asset management industry for a few years now, because their real rates are north of 6%
Mm.
on sovereign money. Can you imagine, a U.S. tip yielding 6% real? 2 or 3% inflation, and you're collecting 9% nominal on 10-year money. The S&P would be below 2,000, because why would anybody own any stocks if you can just collect 9% on a 10-year with inflation at 3 and go to the beach? But that's what that is. So the local asset manager's just been annihilated by people who continue to rotate from equities and other risk to the sovereign, to clip that coupon. And then more recently, the foreigners have started to throw in the towel on Brazil. And when I came back from Brazil, I was joking with a friend of mine, like, if I didn't know where the Bovespa was trading, I would have thought it was at like 80, and instead it's making a new all-time high at 135. And in US dollars, it's starting to move as well. I
Mm,
almost wonder if a country like Brazil isn't sort of I don't want to say the opposite of the canary in the coal mine, like the tip of the spear, of the beta spear,
mm.
where that is most sensitive to some of what we're talking about here, and is starting to give us a signal that maybe, if you were to tell me I was right about everything we just discussed, the natural inference is that a market like Brazil would lead the way. And that's starting to happen despite people's resistance to wanting to invest in Brazil, both among the locals and the foreigners. So going back to the consensus that the market's not confirming, the market's going up, and it's the most clear wall of worry I've seen in several years. And it's coming off of very low valuation levels, to your point. So
That's fascinating.
yeah,
I
there are a lot of
I
opportunities here. I hate to take another 2 minutes, but the quick word on the demographics, which is fascinating to me, and I don't presume to be an expert, but one of my early notes, and for your listeners, if they're interested, um, my first few notes on the Substack, if you go back all the way to the beginning in January, were not behind the paywall. That kind of gives you an idea of how I think. And the second one, there is one, I think I called it Crossing the Event Horizon on Labor and Wages. And it was specifically about the boomers and that pig going through the python that we all kind of know is happening, and trying to just play with some of the census data and health statistics around, like, when is this actually actionable, and we can leave the whole, the accounts by 2040 don't add up, and, like,
mm,
it's all going to blow up. And what I find fascinating is, if you look at the boomers as the kind of second biggest cohort there after the millennials, which are actually bigger today, there was a sort of a rally in births that plateaued from 1956 to 1961. It's kind of like the meat of the boomer years. And in that kind of 6-year time frame, you had 4.2 to 4.3 million births from 56 to 61. That cohort today is right around, call it 62 to 67 years old, the tip of the spear of the plateau. So the median boomer today, or rather last year, turned 67 across the 1946 to 1964 boomer set. But the tip of the spear of the plateau turned 67 sometime earlier this year. And that 67 is key because it's, I mean, my parents are still working, but they're unusual. By 65, people are thinking of retirement. 67, you start to get into focus about having to withdraw from retirement accounts. I believe the hard stop is 70 or 72, where you have to start drawing down IRAs and
mm,
401ks. But at 67, you're now seeing for the next 5 years just a relentless roll off on a net basis of retirees. And one thing I've been playing with that I haven't written about, but is probably up next, is, we're so preoccupied when we think of the unemployment rate at 4.2% in the numerator, which is the number of bodies that are unemployed divided by the labor pool. And it's always been taken for granted that the labor pool will grow. And so if you're seeing the unemployment rate go up, it's because the number of bodies of unemployed has gone up. But there's another way that that the percentage of unemployed goes up, which is that the labor pool goes down and your
mm,
denominator decreases. And it didn't occur to me until a few weeks ago, in thinking back to this note at the beginning of the year, that there's kind of this very small, inexorable trend window in the next 2 to 3 years where we have enough of these boomers potentially coming out of the labor force, and there's a gap in the college graduation cohort for the next 2 years where you may actually see this show up in the data on the margin. Now, I'm not saying that this will matter more than the number of bodies of unemployed. The numerator is still the key, but there's just enough here that maybe for the first time in history, and there have been a lot of firsts in the last few years, and I know what this is going to sound like to a lot of people on Twitter, and people will decry this as silly, but I can't help but shake this view that maybe there's enough pushing back on the denominator, just enough to keep the unemployment rate from exploding, even if you were to add unemployed bodies to the numerator, such that the Fed will see the unemployment rate tick higher, right? The number of people going back into the workforce goes up, like let's say the economy picks up again, right? They engineered their soft landing. But because the denominator is falling because of the net exits from the workforce, you actually get the real wage growth that you're talking about, because suddenly the unemployment rate is going up. These people are leaving the labor force, so the denominator goes down. But we're in a world where there are more people employed in 3 years than today, but the unemployment rate is higher because the denominator is offsetting this. So we live in this really weird upside down world where unemployment at 4.5%, and yet the job market feels tight. And
It would move the natural rate of unemployment.
yes, exactly.
Nehru, I mean, they used to talk about that back in the day when they were trying to figure out the connection with inflation. But that's really fascinating because that's yet another kind of reset.
Yeah, there's a wrinkle in here where, like, again, the Fed isn't solving for growth; they solve for full employment through growth or through wealth effects. But the mandate is full employment. So if if they are, let's say, if they're seeing the unemployment rate kind of crawl higher, they're going to want to cut. But if that unemployment rate is crawling higher because the denominator is shrinking,
Then yeah, unless they switch to look at average hourly earnings and really start to
exactly.
focus on the earnings part. But again, this is a Fed that's tends to be pretty reactive to what we've seen unless something changes, and it took a long time for them to respond to inflation the first time around. The only thing that would be different is if they recognize that the issue was more supply related
Right.
and transitory. We know that they don't think wage inflation is necessarily transitory unless they completely throw the old rule book out. So that, but they'd have to pick up on that quickly. Paolo, if that logic also plays out, do you see outflows out of managed funds in a way where you've just seen these kind of permanent inflows because so much of the US has this weird setup where it's really 401 funded. We all kind of fund our own retirements now. So you've got this steady flow of money no matter what, those
Yeah.
long hands. Could that actually be an outflow that puts pressure on the market or no?
Absolutely. And to his credit and others, individuals like Mike Green have done far more work on where exactly this tipping point is, and the rise of passive, the knock-on effects of how these entities interface with the market and change the nature of price discovery as we know it. Um, the short answer to your question is yes. I think that it is precisely this sort of inexorable shift where buyers become sellers.
Mm. Yeah, we
And
think of passive as, like Tina and it being inflows. Passive can mean outflows too.
absolutely. And, the boomers at some point will let go. Where we get into a funky place is they're about to start retiring in droves. The tip of that plateau of 4.2 million births is 67 this year. In the next few years, we're going to lose several million of them to retirement. And there's going to be, I think, a beat of expectations in terms of the contingent liability that the CBO has modeled. I'm not looking out to 2040. I'm talking like 2028. Just in
Mm.
the next like 3 to 4 years, we're in the same way that the interest bill has surprised everybody, and we're now paying over $1 trillion, and it's more than the military. I think people are underestimating just how much in Social Security is going to go out the door over the next 3 or 4 years, and the the boomers will eventually start to let go. They will have to begin to sell assets and into the face of this. And the Fed, in looking at an unemployment rate that is kind of creeping higher because the numerator is stable, the denominator is coming down, and solving for full employment through cuts, is only going to touch off more of this sort of it's going to seem weird that a Fed that's dovish and looking to support the economy uh, on the employment side of the mandate rather than the inflation and price stability side of the mandate is touching off difficulty in asset markets that just seem to have an offer to them. For me, the tipping point in this isn't right in front of us here in the next few
Mhm.
months or quarters. It's sometime in the next kind of 2 to 3 years. And I haven't wanted to bring it in yet because there's a wrinkle here where I wonder if boomers might not extend their careers by another year or two in aggregate, that pushes this off. But I think that demographics have been something that people kind of pay lip service to for 30 years because we all know that it's coming,
Yeah,
and it's
it's
actually
been the
right
long
here.
out there, talk to me when it happens, big looming issue that no one really I remember when I first started out, and it used to be the academics talked about it because that's how unsexy
Yeah,
demographics were. And one of them very early on, I did an interview with was talking about generational warfare, right? There are all kinds of implications, by the way, of what this means societally as well when you start to talk about money and where the money's being spent and budgeted. But we just extend and pretend in this country. And so it hasn't been, but it sounds like you're saying from an investment point of view, we maybe need to start paying attention to it because it is no longer a long term issue. It may, not will, but may start to rear its head in a much shorter time
yeah,
frame, like the
it's
next
now
few
on a
years.
relative time frame for sure. What I would consider to be intermediate, short term is anything inside a year for me.
Yeah.
I'm not a day trader or a month to month trader, but for me, it's definitely intermediate term. Long term, I tend to think 3, 5 years plus. This has moved into focus, and I'm still. I find myself thinking a lot about this. I don't have the answer specifically to, oh no, this will happen, and it has to be in this sequence. I will say that I find it just amazing. The boomers, they're now 20% of the population. The millennials are the bigger cohort at like 25, but the boomers control over 50% of America's assets, and they're responsible for over half of consumer spending. And the millennials hold maybe 6% of the wealth of the country. Like at some point, the boomers will let go, and either the
Or at
government
some point, the
will.
millennials are going to come from. I
Yeah,
mean, that's like
exactly.
this is where it gets really interesting, and there's some really interesting conversations about what's going to happen because that is a very strange situation to be in.
Yeah.
That concentration and has a lot of interesting threads. Paulo, this has been such an amazing conversation. Your Substack is fantastic. It's always so thought provoking, but great to have you on and kind of think out loud in real time about some of these issues, which we really need to pay attention to. And I think really enlightening for everyone out there as they try to think about what a portfolio looks like. I think a lot of people feel like things are shifting and we might be in a new era, but just how we navigate that and hang on to wealth or try to build wealth, I think is going to be so critical. Just want to ask you one follow-up question because I know someone's going to ask about this.
Sure.
And by the way, as we put everywhere in our description, and you all know this, none of this is financial advice. These are just thoughts about macroeconomic topics that Paulo is kind enough to share with us. Only you can know your own risk. You know this spiel. But if someone listening to this is thinking about that emerging market conversation and really interested in that, is it the kind of things you're talking about? It sounds like you really lean into an actively managed style because there are still other risks you have to understand, whether they're political or currency related,
Yes.
and really understand those countries. I am assuming if somebody wanted to investigate that, a broad like EM ETF or basket, it sounds like maybe a little bit more homework's needed.
Yes.
Am I interpreting that right from listening to you?
I would love to reinforce both of those points. Nothing that we've talked about here is investment advice, for heaven's sake. I'm anonymous. I'm a cloud bearer. You should not be listening to me speak to a financial advisor, see what's appropriate for you. We're all in a different place at any point in time with our finances. So, consider this just the open thoughts of how I think about the world. To your second point, in the same way that I see kind of rolling crack ups in commodities and a certain level of expertise and active approach, as opposed to simple passive allocation, I tend to agree that you'll see something similar in terms of emerging markets. If you're looking to allocate to emerging market equities, the strategy of passive and buying an ETF like an EEM, MSCI, emerging markets type index worked great in the 2000s because there was that tide lifting all boats of China's emergence, dragging along all emerging markets as an asset class for a ride. And it lasted a long time and people made a lot of money in a passive buy and hold approach. I am less convinced in light of everything we talked about and how different emerging markets in specific countries, Mexico is in a very different place than Argentina right now, than
Mm.
Brazil is. And these are all just simply within the LATAM zip code. South Africa, an entity all its own, China
Yeah.
with its own dynamics, India, an active approach with a manager that knows what he or she is doing, I tend to think would add a lot of value versus a passive,
Mm.
blanket allocation strategy, because one size does not fit all. And to your point about politics, geopolitics, and other risk factors, the words political economy used to mean something, but the word political comes first. It's only in the last 30, 40 years that geopolitical risks and general political risks stopped mattering somewhere along the ways. We're in a new world now where I think it's very obvious that political economy exists together in the same phrase for a reason, and these countries are very different. So it stands to reason that an active approach is probably an let's say an intelligent active approach, as opposed to a blanket passive allocation to the space, would probably add value over time. But again, it's not meant as financial advice. It's just kind of the way I think about it
Just an
for a market.
observation, but I thought it was really important because I think the knee jerk has always been to, okay, let me find the ETF that
That's
matches
right.
that. And I think that the point of all of these conversations is just to make us smarter so that we can ask the right questions to our financial advisors and that we can be proactive in the approach and be a partner as opposed to just set and forget, which I think we all feel like has kind of reached its expiration point. So I'm
Hmm.
so happy that you fielded that question because I know it's a little tricky when I'm asking you. It's not what people should do, but it's like how can we think about this? Like how can we approach it from a smarter perspective?
That's right.
And it's really valuable hearing from folks like you who've been in the market a long time when it comes to that. We kind of all need to have a certain level of expertise now. Paolo, this was so much fun. I feel like we could keep going and going, but I'm super mindful of your time.
Thanks, Maggie.
Appreciate you giving so much of it to us today, and I hope we can do this again because it's been fantastic.
I'd love to. I'd love to come back. Thanks so much, and congratulations and good luck to the endeavor there. It was great
Thank you.
speaking with you, and thanks for giving me so much time.
Yeah, no, I love it, and we will do it again. And thanks to all of you for listening. As you know, you can find Paolo on X under his handle and on Substack. Really recommend that you go dig in because these are really important issues. So thanks so much for listening. We'll see you soon. In the meantime, take care and good luck out there.
Thank you.